Hello traders, welcome back to the Forex gig, and in today's video we're going to be talking about the inversion fair value gap and their impact on market reversal. This formation signal key price movement and provides precise entry points for trades. You would learn how to identify both the bearish and the bullish pattern, implementing practical trading strategies and recognizing false signals. So stay tuned as we break down each component step by step. We start by asking ourselves what inversion fair value gap is. And the inversion fair value gap, also known as IFVG, represents a specific market pattern where price action creates a void in the opposite direction of the original fair value gap. As we can see, this is a fair value gap, this is an original fair value gap. When price come and create a void opposite that fair value gap, it is called an inversion fair value gap. Now, what are the structures of an IFVG? That's an inversion fair value gap. It forms when three consecutive candles create a pattern. The gaps become particularly significant because they often indicate potential reversal points in the market. This particular area, when price gets to it, it is a strong reversion point. Unlike traditional support and resistance level, IFVG, that's the inversion fair value gap, provides you with specific price zones where institutional orders might be sitting. So this is a typical example of the IVG. The key difference between the FVG and the IFVG is the FVG typically continues the current trend. That means we expect market to come to that area, retest, and it continues the trend, while the IFVG suggests a potential trend reversal or significant pause in current market direction. This makes them valuable tools for identifying potential turning points. Now let's look at the types of inversion fair value gaps. We'll examine two main types of inversion fair value gaps that you will encounter in your trading. Each type represents distinct character and trading opportunities that you will need to understand. The bullish fair value gap, and the bullish fair value gap forms when price creates a bearish gap and it gets validated. You will then identify this pattern when the middle candle low sits higher than both candles. It sits higher than both candles and the third candle high. This formation suggests strong buying pressure and often lead to an upward price movement. Now we have the second one known as the bearish fair value gap. This displays the opposite structure of the bullish IFVG. The middle candle remains high below the both candles, the first and the third candles low. The pattern often indicates strong selling pressure and can lead to downward movement. So this is an example of the bearish IFVG. When price returns to these levels, they frequently act as resistance zones, providing opportunity for short trading opportunities. The key is to wait for price to reach these levels and show rejection before entering a trade. Remember, this pattern become more reliable when combined with proper market context or market structure, and additionally confirmation signals, which we will discuss in the next section. Now let's see how we can identify inversion fair value gaps. The first way we can identify it is by recognizing specific market conditions that can lead to gap are more reliable. The most effective IFVG appears near areas of liquidity. Look for market highs and lows to get these positions. When an IFVG forms after sweeping a liquidity area, it has a high probability of holding. Now these are areas where we can find this IVG. We can also find it at a premium versus discount zone. We can find these areas at a premium and discount zone. We can also find it by paying attention to market structure shifts. When we notice market structure is shifting, like in this area, when we notice a shift in market structure, when market structure is shifting, we can find this particular IVG. We can also find, to avoid false signals, remember that the IVG becomes invalid if price moves beyond its boundaries. Once price has come to retest or move beyond this area, it becomes invalid. Most reliable IVGs appear when multiple confirmation factors aligned, leading to the next section. So let's see how we can incorporate this IVG to our trading strategy. First step is to wait for price to return to the IVG. When price breaks structure and returns to the IVG, this is when you would want to enter your trade. When price returns to the IVG, we have to place it above the zone to give room for market to breathe. We will enter once price reach the IVG at the high of the IVG, which acts as a strong support area for buy trade. This is a bullish trade. So we would enter when price gets to the area and we'll put our stop loss beyond the IVG zone for a bullish IVG. We'll put it beyond the low of the zone. That's this invisible resistance line. Will put our stop loss just below that zone. This is what it means, giving the trade enough room to breathe. This is what it means. Then in case of a bearish IVG, when we spot a bearish IVG, we will enter the trade at the area when price comes to retest the IVG, and we put our stop loss just above. We put it just above. In bullish, we put it just below, put it just above the region of the invisible support area. This is where we put our stop loss, just above that area. Then we have to set our profit target to the nearest significant structure. The nearest significant structure is the next swing high, should be the next significant structure, which will give us a 1:5. We can also use a previous swing high or low, like this is what I used, a previous swing high or low. We can also use partial take profits by taking profits at 1:2 as your first profit target. Your second profit target can be the area of previous swing high or low, as the case may be. To strengthen your entries, you have to check for 3 conditions. First of all, the time frame aligns with your trade direction, and we have to make sure that our time frame actually aligns with our trade confirmation. This is the first signal. The second signal is to confirm that the volume is increasing during the initial IVG formation, and as we can see, when it was forming the IFVG, the volume was in an increased manner. You can see the volume bar is increased. So this further confirms that the IVG is a strong one. The last confirmation we need to strengthen this entry is to check for a clean structure, and as you can see, market made a clean structure by breaking this area, coming back to retest. Always maintain a minimum of 1:2 risk to reward when managing your trade. If the nearest target doesn't offer this ratio, skip the trade. Always trade when you see there is an opportunity to capitalize on a risk to reward of 1:2 minimum. Also remember that position size should not exceed 2% on a trading capital per setup. That means that you should trade at least 1%. You should risk 1% or 2% your trading capital per trade on this setup. The key to success with this strategy lies in the disciplined execution and proper risk management. This leads us to examine some practical examples. As we can see, when we take this selling scenario, we enter the moment price gets to the IFVG. We put our stop loss just above the high or the low, or be above the area of the IVG. Then we aim for the next structure, or we aim for a risk to reward of 1:2, 1:3. We further confirm this setup with our volume at the area where our FVG was formed. If we can check the volume area and find out that there was an increased volume at that area, this further strengthens our setup, that there was an increased volume at this area when the IFVG, the inversion fair value gap formed. It signifies that this is going to be a stronger setup. Remember, when you take a trade and you see any signs of reversal, you immediately secure your profit and leave the trading setup. Alright traders, we have come to the end of this video. If you found this video helpful, do not forget to like the video, subscribe to the channel and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for tuning in, and until next time, happy trading.